as they say, the number one fear in retirement isn't dying, it's dying empty-handed. Your plan is dependent on the stock market, for example. You're in very volatile waters.
Even bonds.
For somebody getting a little older, coming to the end of their money-making years, it's brilliant. It's a brilliant space because you can have all four elements: predictability, consistency, security, and return. You can create a self-made pension and structure it exactly how you want it.
Hey guys, welcome to episode 3. I'm here with Chris Nichilo, founder of Magnetic Capital Group, and today we'll be talking about the most important part of retirement for Canadians.
What's the most important part of retirement for Canadians, Nick?
The most important part is having enough money to make it to the end once you retire.
Yeah, it's really simple, right? It's a plan, right? You got to have some sort of plan once your money-making years come to an end, if they do, or once they slow down, right? Or change in a significant and sort of negative way. So you walk away from a full-time job that's paying you 6 figures every year, and now you're into pension income that's paying you half of that.
Yeah, if that.
You become accustomed to a certain lifestyle, a certain income. Question is, can you fill the gap by removing yourself from the workforce and replacing yourself with a way for your money to make money for you? So you make your pension, and then you fill the gap with something else. Now, what if you don't have a pension? Then the plan is, how can you create a self-made pension?
Yeah,
right?
I can say that, both my parents retired last year, and it's definitely, it's a lot of spreadsheeting, a lot of lifestyle adjustments, and it's pretty stressful because, the boomers were promised one thing when the whole paying into whatever the government retirement fund is, and adjusted for inflation, it's much less than what they were promised.
Well, and things have changed a lot. I mean, like when I was growing up, it seemed like my father and other fathers I knew kind of worked at one company for a long time, built up that pension, and got a nice watch on the way out, kind of thing, right? But today, it's very different. I mean, a very transient workforce now. People moving from place to place, not really staying at one, changing careers, right? And so when that's happening, you have to you could agree, being able to understanding how to invest becomes more important for all of us, right? In that type of world, where before, the investing was done by the pension fund or whatnot. My father was in education, so he was in the teacher's pension, right? So it was very, very safe, and you kind of knew what you were gonna get. Now, guys like me, for example, guys like you, working in either working for yourself or working in a different type of industry or whatnot, and you got to take charge of it yourself. So
I'm under no illusion that I'll be relying on the government when the time comes for me.
Yeah, I mean, then as they say, the number one fear in retirement isn't dying; it's dying empty-handed.
Mm-hmm.
So the question is, how can the average person invest comfortably, safely enough to produce what you need to build a self-made pension, so to speak, right? You need predictability, very important, consistency, security, right? Above all, because you can't lose. When you get, the later you get in life, the less the less you can afford to lose, because time becomes your enemy.
Yeah. If the market's down for 3 years, that's kind of putting a bit of a monkey wrench in your situation.
So predictability, consistency, right? You need something that's going to produce predictably and it's going to produce consistently. Then you need security because it's got to be ironclad, and you need return. This is the piece. This is the magic piece. How much return do you need? Now, if you look at those elements that I just laid out, predictability, consistency, security, and return, and your plan is dependent on the stock market, for example, you're in very volatile waters.
Yes. Even bonds.
Yeah. So the question is, what's the vehicle and what's the return that you need in reverse order? What's the return that you need and what's the vehicle that can get you there? Now, here's the good news. At this
Would you
stage,
say, would you ask the question, what's the return that you need, or what's the dollar amount that you need?
you need to determine what the return on investment you need is. Now, you may find out that your need is higher than you can get without taking too much risk. That's just a product of the nest egg you're working with and the lifestyle that you're living, right? So if it's not enough, it's not enough. You can try to force it, but if you do, you're going to take more risk than you need to. You're probably going to get a bad result.
Yeah.
So you have what you have. Well, I'm not this podcast isn't going to be, hey, you don't have a lot of money. I'll tell you the magic trick to turn it into something great anyways. That's not this podcast.
You're
This
not
podcast
encouraging
is
buying pre-construction condos, or
no.
no?
No, one thing, I'm a one-trick pony. I stay in my lane. The one thing I've found that you can count on, and of course, I'm now a very loyal student of the space. The number one vehicle is a private mortgage secured against a residential property. Now, in Ontario, actually, that's what I know in Ontario. Now, you go outside, I'm sure I could apply the principles of what I do in Ontario in Manitoba or any other province, but the marketplace is a little different. You got to learn the marketplace. But my market is Ontario. I know how to do this. Now, the elements that make it what I consider to be an ideal investment, especially for a retiree, is it's tough to find better security. Okay, so the collateral is excellent. Someone's house. It's very powerful collateral. We don't need to go too much deeper into that. You know the elements of why. Now, it's very powerful collateral, and it's the same collateral. This is the interesting piece. It's the same collateral that the homeowner offers the bank, who can offer them a rate of, several points lower than a private mortgage. In private mortgages, we get the same collateral the bank gets, but we also get a premium return on investment.
Right.
So you're getting the best of both worlds. Now,
Yes.
question is, what do you need to survive as a retiree? Now, again, depending on the size of your nest egg, there's only so much it can produce once you understand where the sweet spot is between risk and return. How much return can you get without taking too much risk? Consistently and predictably. I think that number's around anywhere between 7 and let's say 6 and 10%. That's where it is.
Higher than that, it's getting risky.
Yeah. Well, first of all, if you have a big nest egg, if you have, if you own your house, you own your car, and you've got $1 million invested earning 6%, that's $60,000 a year. It's $5,000 a month. If you can live on that and you're good with it, because you don't have a mortgage payment, you don't have a car payment, you don't have any of the big things, you're good. Why would you take 7% risk? For an extra 10 grand, you take right? No point. 8%, 9%. Now, why do I say 6 to 10? Because there are private mortgages that live in the 6 to 10% world that are great. So like you can build a portfolio of 9s and 10s. You can also build a portfolio of 6s and 7s. And the spectrum of risk between 6 and 10 isn't so crazy. I think
So,
when it gets above 12, that's when you get into trouble.
okay. So you would have like, let's say you've got the yielding portion of your portfolio, and then
Mm.
that's like further split down into, I don't know, like $1 million. That's what, maybe
Well,
10 deals in circulation?
yeah, could be less. I mean,
Okay. Okay. So assuming if we go up the risk curve,
mhm.
the risk of default is higher, which in private mortgages, especially those managed by Magnetic, from what I understand, is like what, 1 to 3% default rate. So if you go higher up that risk curve, you've got 10 deals going. Maybe eventually one of them takes a little bit longer to pay out in an event of default. So you can allow yourself to have maybe a third of it, like a bit further down on the risk curve, and then your super solid base is like 6s and 7s.
Yeah, I mean, listen, if you're investing at any time in your life, typically you're going to have a portion of your portfolio that's directed at what they call fixed income assets, high interest savings accounts, GICs, rock solid security. But what's the trade off?
Low yield.
Yeah, very low yield, right? So, a GIC or a high interest savings account might earn 3 or 4, especially if it's being managed by a wealth manager, then you're probably paying some sort of MER on that as well. Bond, same thing. But if you can get security that once you look at it, like once you understand the security and you go, feels just as good as a GIC. Okay, feels just as safe. You don't feel any less safe. So if you look at this security and you go, I don't feel any less safe, and I have $1 million, and $60,000 a year is plenty for me. If you check those boxes, then you take the 6%, and it's like having your money in the best fixed income asset category you can. Now, as you get older, what happens? More money goes into the fixed income side of your ledger, right? Then you're taking less volatile risks elsewhere in
Yeah.
other vehicles. So
Yeah.
maybe you go from, in your 40s, you got 20% of your book in fixed income. And it's really what that is that's the base, the foundation, right? Strength. You can count on it. You don't worry about it. You don't lose sleep at night. But 80% of the money is spread out in other things, you know, trying to catch a bit of a better yield and take as little less risk as possible.
A little home run.
But we all know as we're doing it, we're like, yeah, it is a little bit riskier, that 80%. This 20% is rock solid, right? And as we get older, you start looking at it and going, maybe I feel better if I had like 40% in fixed income, in the rock solid stuff, and take a little bit. You go through a couple ups and downs, you see the good, you see the bad, right? You did okay. But now you're getting a little older and you start thinking, time, like I turn 50 next week. I feel good, but you realize 50, So you start to think time starts to matter. You don't have time to make mistakes. You need more consistency, more predictability, more security, but just get the return that you need. So if you're the guy, right, or the couple or the woman who has $1 million, can live on 60 grand a year, take 6. If you need 70, take 7. Take 8, take 9, take 10, take a mix. There's so much you can do, but you're going to live between 6 and 10. If you have to get more than 10, you're not building a self-made pension. You're still sort of gambling, right? You're once you get above 10, in my opinion, the higher you get, obviously,
It starts
know.
turning into hope.
Yeah, there's an element of that, right? So, it's, what I'm here to say is you can find a really solid book of private mortgage loans anywhere between 6 and 10, and I think be very comfortable, right? And, if you're not right now, I can help you. Like, I could talk to you and explain it to you why you should feel comfortable and how it works. And it's all layman's terms everyone can understand. So it's just a matter of paying enough attention to understand the philosophy. It's all we do, right? Just this one thing. And so, you know, for somebody getting a little older, coming to the end of their money making years, it's brilliant. It's a brilliant space because you can have all four elements: predictability, consistency, security, and return, right? So you could live in that 8% range very, very comfortably um, till the end of time. And so if you can get by on your 60 to 80 grand a year, the million doesn't erode.
Preservation of capital, no drawdowns.
Yeah, that's right. So you've got that as your safety net, your security blanket, and also something to leave behind to somebody else.
Speak to the risk being time versus loss.
Well, the time is the risk is time. Okay, I'll give you a great example. So,
because they're going to be like, well, oh, this sounds great, but like, what's the risk? Like every investment has risk. Okay, I'd like this 10%, 9 to 10% idea, but
let's
I
see
find the
6 to 8 in retirement. I think 6 to 8 is where you want to be.
Okay.
Time. Yeah, I mean, I'll give you an example of that's not necessarily related to being in your retirement years, but years ago, I was in this debate, like a public debate, not a set debate, but we were panelists on the same stage. And the person I'm talking about was a wealth manager. And of course, I just do this one thing, but he does a lot of different products and whatnot. And the host asked us both what the last 5 years looked like if 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 either one of us was managing a portfolio. And I went first. I said, well, it's really simple. At that time, the rate of return that we were getting was 8 all day, every day. It was 8. So it was 5 years, 8% average, 40% return on your money over the course of 5 years. That simple. And then the other guy, he said, well, we've averaged over 10% every year. And the guy said, the host said to him, really, over 5 years, you've averaged over 10%. He said, well, if you take out 2013. And of course, the host kind of chuckled and was like, well, you can't take out 2013. What happened in 2013? He's like, well, everybody lost 30%. I think it was 2013. Could be wrong. Is it?
2012,
But you get the idea. Whatever year it was. Yeah, everybody lost. And he looked over at me and I was like, we didn't lose. Still the loan still paid 8%. Market did what the market did, but the loan still paid 8%. And we did the math. So we started working backwards. We said, okay. So I think at the time the second year of the 5 was the year that lost 30%. So every other year went up by 10. So you start with 100,000. Remember, for us, it's 140 in 5 years. 8% times 8, like 8. And for him, it was up 10. So after year 1, 110, and then down 30%, which is 33,000. Right? So you're at 77,000. Then up 10%. So call it up by 8,000. So to 85, up by 10 again, round up from 85 to 9,000. 94, and up 10 again, up to up to
94,
no 103.
103. Yeah. So now you're back to break even.
So after 5 years, you made $3,000, and with us, you made 40. But that's not the point.
No, that's not the point. It's the
The po-
critical point is that averaging 8% and consistently making 8%, there's so much more peace that comes with the consistently making 8% than averaging 8%. Even if you average 10.
that's true. That's a benefit, but don't miss the huge point. And back to the question that you asked, which is, why is time so much more important? Because here's the sickness. The wealth manager, nothing wrong with him. Like, he was being honest and great guy. But what you have to remember from that story the most is that after 5 years, his client didn't lose money, made money, made $3,000, but he lost 5 years. That's why consistency and predictability are so important.
Yeah.
That's why we look to lend in neutral markets. Not too much appreciation, not too much depreciation. Keep everything the same. Just keep it the same. We're okay with our 6, 7, 8%. Just keep it going.
No need to time the market.
No. And again, no period of time where you look back and went, I just lost 5 years. I can never get back. Like, that matters over the long haul.
Well, from 60 to 65, just gone. Yeah.
And then you start over. You got 103.
Mhm.
Even if you had 110 or 108, that one dip in the 5 years, that one period of volatility sets you back, and you spend so much time making up for it before you can actually move forward.
And no one can
And
predict the dip.
that's why the tortoise wins. Just slowly as you go.
And we can't say looking around.
So boring.
We can't say looking around that there's a lack of volatility in the air at the moment.
No. I mean, but this isn't about one investment being better than the other or whatnot. I'm not here to wave the flag of a private mortgage for everybody under every circumstance. I'm just saying, in certain scenarios, like a retiree, it's a glass slipper. Checks all the boxes. Private lending is largely unavailable to people under 40 for the most part because they don't have enough capital yet. So, it's good for them to buy the real estate and leverage it and build some equity and whatnot. But as you get older, and they take more risks when they're younger with investments and so on. And they can, because they have time on their side. But as time starts to get a little shorter, from an investing perspective, I don't think there's anybody on the planet that would argue it's smarter to start moving more into fixed income. And then you look at fixed income and you go, 3-4%, not even the rate of inflation, not good enough. That doesn't work, right? That's where the plan falls apart. Great product, great security, consistency, predictability, not enough return.
Right.
You need the extra yield. So where can you get it? Well, there isn't anything that you can get 6, 7, 8, 9, 10 that has better security, in my opinion, than a private mortgage against a residential property in Ontario.
I haven't found it.
Yeah. Well, listen, at worst, it compares as good as anything else out there. Like, it's top of its class. And given that it's fixed income, it's great. Now, people, it's funny. A lot of times I hear people talking about, oh, I got to pay tax on that and so on. You do, it's taxed as regular income, but you have to just remember its purpose. It's like a self-made pension, which you also pay tax on.
Right.
It's
Well, I
just a
mean,
self-made pension. It's just an income stream. No different than if you were working.
and to build it
So
up, like you're still using TFSAs and RSPs and stuff.
sure, you can get some tax benefits that way and whatnot. But it's the right context, the right perspective of how to think about it. This isn't like you're buying businesses or you're investing in stocks and you're trading constantly, and then you're thinking about capital gains and how to manage it and so on and so forth. This is just very straightforward income stream.
Right.
Income stream like you've had your whole life and you paid taxed on it and it was just your income. You're just replacing your time for money transaction, right? Your exchange of time for money for your money's doing the time to make the money.
Can you speak to the flexibility of it? Like the monthly payouts to me is just like extra gravy because typically GIC, you're locked in for a year or two. If it's like a yielding portfolio with like dividend stocks or something, there's a penalty for.
Well, you're getting your regular payment every month, which is great, barring interruption. And interruption is a reality in private mortgages, although fairly rare. If you do things right, it's very rare. And if you're concerned about that, you get into a pooled vehicle, right, where you don't worry about that at all, right? And so if you're a 6 to 8% income earner, that's why Magnetic we're launching the 2 mutual fund trusts at the end of this year because they give you a pooled vehicle to go into. You don't have to worry about interruptions.
I see. The retirement guys aren't looking for the syndicated side.
No, I would
Okay.
take.
I see.
There are multiple ways to participate in a private mortgage. I would steer you as you get closer to retirement away from that and into a pooled vehicle.
Gotcha.
Gives you because it gives you it's like giving you a premium on consistency and predictability.
Okay.
Right? Yeah. So it's the right way to go at that stage. But when you're, right in your money making years and you want to get a little more yield, you can participate on the syndicate side and do fantastic. That's where you can get into that 9, 10, even 11, right?
I remember.
Yeah. So there's different ways to work in that spectrum. You can also, once you understand how to do it, you can easily balance a portfolio, take some 6, some 7, some 9, some 10, and mix it all in. You can also play with liquidity, right? By staggering when you do each loan so that, you've lent the money out for a year, but you've done 5 of these 2 months apart. And now every 2 months, you've got something coming back to you.
That's an even extra bonus. I love that.
Yeah, there's lots of things you can do. So what's nice about this, to kind of put a bow on all this, is that you can create a self-made pension and structure it exactly how you want it with just a little bit of consultation. Like if I talk to you for half an hour, 40 minutes, and you were open enough to share you were comfortable enough to share your personal details, then we could sit down and we could just I jump in your shoes and teach you, okay, well, this is what I would do if I were you and had your circumstances to maximize or optimize participation in private mortgages and create the most security, the highest return, and like a sort of a plan that you can count on for years and years.
I'd say looking forward to that conversation, but I'm not like looking forward to retirement. But
I know.
I would definitely be having that conversation if I was
Yeah.
there.
So, all right. Well, till next time.
Till next time, that covers retirement. See you later,
Yeah.
everyone.
Okay.
Bye
Bye-bye.
bye.